Hello and welcome again to another financial analysis video with myself, Moeed Amin, and my colleague, Ted Wayman. So today we're going to be looking at BMW, which is a nice change of pace from a lot of the tech and surprisingly mining companies that we get a lot of requests for. So we're going to be looking at BMW, very well-known automotive business. And interesting facts about BMW. So founded in 1916, in fact, developing cars was not their first product. It wasn't even their second product. They initially developed four-cylinder engines for aircrafts designed for pilots in World War I. And they also developed the engine for motorcycles first before they developed engines for the cars. So quite an interesting fact that I found there. Now, just before we go into the financials, quick note, this came as a request from one of our viewers, and actually a very interesting request. Seems to be someone that's either been watching our videos quite a lot or has drawn their own kind of conclusions and looking at their own analysis of these kind of companies. And what you'll notice from what this person, Tim, has asked us and explained here is, their PA ratio is 4, they seem extremely cheap, and they have a dividend yield of around 7. So stick around because we're going to come on to that later on. And we're also going to be looking at their finances, and they've published a quite recent set of audited annual financials that we will go into. Before we do that, one quick note around the share price. So right now they have about almost 119,000 employees, so quite a sizable business. And their share price from 1996, if you'd invested then, you would have seen an increase of 486%. So significant, definitely not in the 4,000 realms that we've been seeing with some of the companies we've looked at in the past, but definitely not something to be sniffed at. In the last 5 years, you would have seen a decline of just over 3%. And then last year, a decline again of just over 3%, this time 3.47%. So we're going to look into that later on as part of the complete financial analysis. Before we go into that, one final point that's important. We are not here to give you financial advice. We're not here to give you investment advice. There are plenty of others out there that can do that and do a very good job of that. Our job is to raise the financial knowledge and fluency of the population. As Warren Buffett says, finance is the language of business. So it goes without saying, if you can't speak the language, you really can't do business very well. So no matter what your profession or what you're trying to achieve, it's highly likely that financials are going to be important in what you do. So becoming financially fluent is very, very important. And that's what we're here to do. So whether you're thinking about BMW as part of your investment thesis, or whether you're thinking about selling your services or products to BMW, or even if you're thinking about joining them and becoming an employee there, you've got to know their finances in order to have a smart conversation. So stick around, we're going to be covering that. So Ted, I think I've covered that introduction now of BMW. Over to you around the finances.
Yeah, good to see you, Moeed. Thank you very much, and welcome to our viewers. What Moeed did forget to say is don't forget to like, share, and subscribe. So if you are new to the channel, please do subscribe. That helps us to kind of gives us an incentive to produce more videos. If you like what you see, then give us a thumbs up, and also give us a comment if you want to make a comment. Maybe you give us some insight. Obviously, if you are going to make the comments, then please do so politely. So let's go and have a look at BMW's financial statements. And as Moeed said, these are relatively new. They've just been produced. You'll notice that the future is electric, digital and circular. So they are, and these are the 2021s. They are available on the BMW website. Tells you a lot about what the company is up to. Big push into electric cars. So quite interesting when we get our friend Tim says, can you have a look at these accounts? Because I'm looking at things like Tesla and NIO and Arrival and all these kind of companies, which are, really, priced on very, very high multiples of earnings, which makes them very, very expensive. And then he says, well, hold on a sec, BMW, really, really cheap. can you have a look at it? So any kind of comment like that, any question like that, immediately I'm like, oh yeah, let's go and have a look at that and see what's going on. So here is BMW. Now you'll notice they give us a kind of a breakdown of the various parts. You'll see motorcycles over there. Moeed mentioning motorcycles was one of the early, and I'm a big fan of BMW motorcycles. Moeed, I actually ride a GS 1200 Adventurer, which is the kind of for those of you who watch the Charlie Borman long way round, long way down kind of stuff with Ewan McGregor. So I'm a big fan of BMW motorbikes. I love my motorbike. Anyway, let's not digress too much. So here we go. Here are the accounts. And top line, we see first of all, we see the sales. There's the sales. So we're looking at these two columns and we notice that these guys have managed to achieve a 12% increase in sales. So 12% increase, pretty substantial increase. And they haven't managed to they've managed to keep their cost of sales down relatively, so the cost of the gross profit has grown substantially. Look at that, it's almost doubled, Moeed. So they've gone from a 14% gross margin in 2020 to a 20% gross margin in 2021. Now there's the question, which of those is an anomaly? So if you are sort of familiar with the concept, we'd expect the gross profit margin, that's the gross profit expressed as a percentage of sales, to stay constant as a company grows. For example, we're sort of saying here that, you know, if you buy a pen for $1 and you sell it for $5, you make an 80% gross margin. If you buy 1,000 pens for $1,000 and sell them for $5,000, you're still going to be making that 80% margin. So that, you know, now not all things are equal, but that's what we expect. So the big question is, we scratch our heads, no answers here, but that new 20% gross margin, can BMW maintain it? Because that is driving this profit figure. Look at the bottom line, the profit figure here. They've driven it from about 4 up to 12. So a massive increase there. And again, we can see even at the operating level. So all the other numbers, you know, SG&A, you know, pretty flat, little bit of an increase. They've got some this interest and similar expenses, interest income. We're going to talk about those two numbers a little bit later on, and this kind of other financial results as well. But really what we're seeing here is that this company has, you know, they're just, you know, they're producing the cars, they're still selling them, you know, at a high margin, but they, you know, the cost of producing them is much less. Now, 20% gross margin is actually quite a low gross margin. That means for every, you know, $100,000 that you buy a BMW for, it costs them $80,000 to make the car. So, you know, you're getting quite a lot of bang for your buck there. But, you know, these guys, you know, they've managed to control their overheads. Their overheads only sitting at about 8%, which means that they are, you know, making this, you know, it's an 11% bottom line net margin, and that's pretty good for that industry. Okay, and remember, we got to look at it on an industry basis, but certainly much better than Tesla, for example. So there's our income statement, looking pretty healthy. So let's go and have a look at their balance sheet, which I think is a little bit further down. Here it is. So I just keep sort of zoomed in, so to speak, because then we can see the numbers more easily. So non-current assets, here we go. So these are the non-current assets. So this is what they actually make the BMWs with. So for example, they're based in Munich, one of my favorite cities to visit. Love visiting Munich, obviously home of the Oktoberfest, which I've never been to, but you can go surfing in the English Garden, and they have a factory there where they make the BMWs on each floor. So I think they start at the top. So they take all the raw materials up at the top, and then they just make it, in the factory production line kind of goes round and round all the way down. And out down the bottom comes a BMW. I think it's the 3 Series they make there, but I'm probably wrong, and somebody will correct me. But be polite but do leave your comments in the notes. So without waffling too much, sorry. So these two numbers here, these are the big drivers, which are, so the property, plant and equipment, and the leased products is their manufacturing equipment. Now, leased products is kind of stuff that they haven't bought, they've kind of leased it, but it's still stuff that they're using to actually produce that manufacturing. I'll come back to this one here because this is quite an interesting number, but we'll come back to that one in a minute. Let's just go and look at the current assets. So for the current assets, we've got cash, lots of cash, 16 billion euros of cash sitting there. and a fair amount of inventory as well. But we will now have a look at this number here. So this number here, okay, which is the receivables from sales financing and the receivables from sales financing, this is effectively the owners of BMW. So people buy BMWs and they buy them on credit. And so what BMW do is that they lend money to their customers to be able to afford their product. Now, you're not going to see that in something like Coca-Cola, for example, because Coke doesn't need to lend you the money to buy the can of Coke, but $100,000 for a BMW or plus, you know, it's quite substantial, and most people can't afford to kind of save up that money, so they buy on credit, and you know, so leads a lot of people to say, well, BMW looks a little bit like a bank pretending to be a car company. You know, effectively they're kind of stuffed full of loans, effectively big old loan book there of you know 87 billion euros, which is fairly substantial. So that's a kind of, you know, that's a kind of slight anomaly, and we're going to see that kind of coming through when we look at the working capital requirement, because it's going to be a little bit of a distorting factor. So you've suddenly got quite big numbers coming through there, which is the loan book of BMW. Let's go down and have a look at the liability side. So the liability side, looking down here, what we can see is the financial liabilities is a substantial amount as well. So these two numbers, these financial liabilities. So in effect, what BMW is doing is that they're borrowing the money. Some of that money they're using to buy assets, and some of that money they're using to lend to their customers to buy their product effectively. Now, they're not dividing those two out, but you know, you see these guys, you know, they have a lot of, you know, usually you wouldn't see such a high level of current financial liabilities. This is a little bit of an anomaly. You might find a company with lots of debt. And we obviously want to make sure they can afford that debt, but these guys, their financial liabilities, current, which is short term, relatively high, but there's a matching thing. So there's a matching thing going on here where they're kind of lending short term, they're borrowing short term to lend to customers short term, they're borrowing long term to lend to customers long term. There's a kind of a matching your liabilities kind of aspect going on here. Can they afford it? Well, yes, they can. Just nip back up to our income statement, and we can see the interest and similar income, interest similar expense here. And then I think this other financial result, we can have a look at note 12 if we want to. It's not a massive number, but I think that what we'll find there is that this is kind of the money they make on that financing. So they'll show it as a profit on the financing of those cars. So balance sheet looking reasonably strong there. So the you know, they got a lot of equity in there. There's the equity, 75 billion. You can see the retained earnings has increased from 61 to 74 billion over the year. Sorry, that's these numbers here. There's our sort of our revenue reserves. There's a little bit of investment dating back to whenever, but you know, these guys are, you know, they're really keeping the profits in the business. They're reinvesting them. They are paying out dividend. We'll see that when we look at the, in fact, we can go and have a look at the movement in equity now. So here's the movement in equity, and we are looking at, in effect, these numbers here. Let me just check where we're trying to get to. So retained profits are the revenue reserves. Here we go, and we can see that. So there's the net profit coming through. Let's just highlight that. So there's the net profit for the year, and we'll see that they're paying out a little bit of dividend. So you know, there's a little bit of a dividend being paid out, but most of that profit is being kept back in the business. So cash flow, how are they doing on cash flow? Again, you know, cash flow is going to be quite difficult to kind of assess. Sorry, let's go back to so here's the cash flow. So the net cash inflow from operating activities, that's this number here. You remember, Moeed, that I always say you shouldn't have a favorite, especially when it comes to kids. I've got 5 kids, and all of them are my favorite, as I tell each of them every day. That is my favorite number because it's a cash number. Okay, so these guys are making a profit. They're making a cash profit. Look at that cash profit compared with the previous year. It's still pretty high as well. So these guys are generating lots and lots of cash, which is good. Scroll down a little bit and we'll look at what they're doing with that cash. So they're doing a little bit of investing. That's about 6 billion of investing. investing in property, plant and equipment. Those are these numbers up here. So yeah, that's basically it. They're investing in, you know, new manufacturing. And then you'll see here a bit of refinancing of those financial liabilities going on. As long as those numbers are fairly similar, I'm not too worried. And then you can see they are paying out dividends on this line here. So there's you know, the dividends are pretty consistent. So most of the profit being reinvested back into the business, a little bit of dividends being paid out, keep the shareholders happy. You know, it's looking pretty strong, looking pretty comfortable there. So let's go and have a look at the share price, as you mentioned, Moeed. So the share price, I have to admit, when I got the request, I was kind of scratching my head a little bit and thinking, nah, it can't be down at a P ratio of 5, and it is. There it is. It's a P ratio of about 5 times earnings. So the company is worth 54 billion. That's the market cap. That's this number here. So the market cap, that's the market capitalization, or the kind of the value of every single share. If you wanted to buy all the shares, cost you just over $54 billion. So $54 billion, you know, gives you a 4%, sorry, 4 to 5 times PE ratio, which is a yield of about 25%. You kind of scratch your head and think, hold on a sec, that can't be right. Now, I guess it really comes down to that sustainability of that earnings figure. So if it's a one-off, if they've just managed it by some kind of, you know, fluke, for want of a better word, then maybe it isn't sustainable. But even so, dividend yield of 7%, I'm kind of thinking, you know what, that looks pretty tasty. You know, BMW, good solid car, it's not going to go anywhere. It's investing in electric. It's going to be around for a long time. So I'm sitting there, maybe thinking, you know, really, you know, I have to admit, I haven't been an investor in BMW. But I'm thinking that, you know, actually I should probably, you know, I'm quite tempted to put this in. This looks cheap, even if that 12 billion is a kind of one-off. It's like, you know, it's not going to crash into zero. You know, it's a good brand. It's a good make. It's well respected. They bought Mini, for example, you know, the old Italian job, classic British car, and kind of built it into a kind of, you know, that German engineering, and it's now not quite the Mini we remember, the Mini Cooper, but it, you know, it's a good solid car. So they do produce good cars, really good brand, really good, you know, kind of German engineering. You know, they'll get it right in the you know, they are getting it right. They will get it right in the electric cars. I'm with our viewer on this one. I think I might add a little bit to my portfolio, Moeed.
And just to remind our viewers, these are our opinions. They are not financial advice. I got to admit, I mean, I look at this all from a sales perspective, Ted. You know, if I'm going to be selling to a company like BMW, what are the things I need to look at? What are the financials telling me? But as an investor, I might look into this a bit further. So thank you to our viewer for making this recommendation. That was very insightful for us to go through. And if, like our viewer there, if you want us to analyze a business for you, whether you're thinking about investing in them, selling to them, or joining them as an employee, do leave a note in the comments section. And just as this viewer did, put as much context as possible, because as you saw, it piqued our interest and it prioritized this person up the ladder. So do leave a note in the comments section, like, share, subscribe as always, and we'll see you on the next video. Thank you, Ted. Thank you, everyone else.
Good to see you, Moeed. Catch you later.